All right, we should be live. Diana, welcome. How are you?
Thank you. Thank you. Great. Yourself?
I am great. I cannot complain. Doing well, doing well. I've had a ton of questions. It's that time of year. It's tax season, right? My favorite season. Said no one ever.
Nope.
But Diana here, I've been trying to get her on here for a couple of weeks now. She's very busy, but she has blessed us with her time. Diana, I really appreciate your time. Today, we're really talking about taxes at a super, super high level. Diana created SDS Consultant. I'll drop her website for you guys to contact her if you are curious about working with her. So essentially, accounting and all things real estate. She seems very good at what she does. I'll kind of kick it over to Diana. Give us kind of a run through with how you got started in this and how you started your company.
Thank you. So my company is Small Business Financial Consultants, and that's exactly it. The name says it all, kind of. That's what we do, how I chose to specialize in real estate and the history, and it's all things accounting, financial planning, tax planning, all budgeting and anything related to accounting. The reason I chose real estate, I think I had the professional identity crisis a few years ago. I was, a CFO and accountant for many, many years for larger corporations, and I've been a real estate investor for 20 years also. And I realized there's this pretty serious gap in accounting services where us as real estate investors, we don't know where to turn, especially when you first start, when you're smaller, you do a part of it, but then accountants don't have a part. So we almost act like an outsourced CFO most of the time, but also, entering data. And, I'm very passionate about real estate myself. I've done it all. I've done commercial, I've done residential, I've done rentals, I've done Airbnb. So I kind of know what it looks like and know how to convert it into clean books, into your clean profit and loss and balance sheet, and don't raise any red flags also. That's a big one.
That's very important, right? I like what you said about the outsourced CFO. That's really important to, really anybody here. Most of the people in this group are either wanting to get into real estate or have some type of investment, probably a smaller portfolio. I would say maybe 1 to 5 pieces of real estate. It's definitely the small people that don't have the time and budget to hire a real CFO. So outsource CFO, I really like that one.
We become kind of fractional service of, like you said, majority of people cannot get the CFO on their staff for $100,000 plus. But you can do that for a fraction, kind of us.
So I have a couple questions. I put a post in this group a couple months ago on essentially what are your accounting questions. So I've kind of allocated, I think we have maybe 5 or 6 for Diana. I'm just going to kind of run through those. I'm sure there's going to be some kind of tangent questions. Once again, if the watchers have questions, put it in the comments down below. This is your chance to essentially lend an ear to a professional accountant. Accounting is way over my head. So this is going to be educational for me as well. But really the first question that I have for you, Diana, and I get this literally all the time, and I myself have asked this multiple times to multiple people. Essentially, like from a tax perspective, what are the pros and cons of purchasing a rental property through an LLC?
So the beauty and the confusion of LLC. LLC, for all intents and purposes itself, is more of a legal shield to protect your assets from, in the case of lawsuits. That is not, it's literally just a type of entity, However, your tax status has to be elected. LLC can function as a sole proprietor, partnership, S Corp, and even C Corp. So LLC can mean all 4 of those things, which are taxed fairly differently. But liability-wise, that's a layer of protection, of course. I'm a big fan of LLCs. I buy all my properties in LLCs or trusts. The majority of my clients, pretty much everybody, maybe when you first start, it's kind of the biggest hiccup when you first start is the bank is not going to give you a loan for the property on your LLC. Your LLC doesn't have a credit. However, as soon as you can transfer the title, the quick deed or whatever it takes to transfer the title to LLC, it's totally worth it. Now, to accounting, because you can be all 4 of those things, it's very different. In essence, LLC is what we call a flow-through entity, and you probably heard that term, to where, all of your income flows, anything you made flows straight into your personal taxes. And that's where you make that election. When you can make an election either when you open an LLC or as you go in at the beginning of the year, any calendar year. Cannot do it proactively, cannot pick, I'm going to be an S Corp from 2 years ago, but you can elect at any given time and say from this date, I am partnership or I'm an S corp and want to be taxed as such. Sole proprietor functions exactly like you would be a 1090. If you pick sole proprietor, functions exactly like your 1099 job. You're paying all the self-employment taxes. It's literally like you just self-employed. Partnership, anything that partnership has to file tax return. It's a 1065 form, if that tells anybody anything. But then partnership takes those profits and splits it into K1 forms that everybody probably knows, partnership income. And that K1 number travels to your personal tax return also. S corp gets a little bit different from these two because S corp, IRS expects you to pay yourself a salary, what we consider a reasonable salary. Reasonable has never been defined. Every CPA has about 17 definitions. What is reasonable? Essentially, if you can elect it and not pay for a couple of years, maybe you're just starting and you don't have money for payroll, it's that beginning is always cash flow issues. We all know it. IRS will look over it for 2-3 years. And then afterwards, if you're not paying yourself as a true W-2 employee, we might disqualify your S corp, saying that it just doesn't qualify because you don't have W-2 employees. Now, the two big benefits of an S corp: functions as a corporation, so your liability shield is pretty strong as long as you're doing everything correct, not commingling the funds, not using the business credit and debit cards for your haircuts, things like that. So it offers you that shield, but also it doesn't tax as a traditional corporation. There's no double tax, what they call it, where you're getting taxed on a corporate level and then on a personal level, whatever you take out of that corporation. In an S corp, you're getting taxed on your W-2 income, and sweet part of it is your company picks up half of your Social Security and Medicare tax. Now it's not you personally anymore, as it would be for sole proprietor. Your company gets to deduct it. So it's a legit, and whatever profits are there then flows into your personal. So there's definitely advantages. You would have to stop me. I would have to talk forever.
No, this is really good. It sounds like there's not a cut and dry answer.
No, it's definitely for each person's situation.
Yeah, everybody's going to be a little bit different. Like our scenario is a little bit different than the next investor and the next investor. So if you have specific scenarios, reach out to Diana, get her expertise here. Everybody's going to be a little bit different. Like if you were to simplify everything as much as possible, Diana, somebody's just starting out, like they're wanting to get into real estate. They don't really know how. They've heard a lot. They've listened to Bigger Pockets. They've listened to us. They're not really sure what to do first. Like, would you say get it into some type of LLC, or would you put it in your personal name to begin with from a tax perspective?
So from the very beginning, I think there's, and it's our fault as accountants and attorneys. We tend to make it overly complicated for the beginners. Do a million LLCs, every property in a different LLC. No, so many of us, gurus out there are like, you need this type of structure for rental, but that type of structure for flips, but the different kind of structure for Airbnb. You just starting out, don't do a thing, because you don't even know how successful you're going to be in it. Leave it as a sole proprietor. For the first year, for the first property or two, it's never too late to convert it, as long as you keep in really good insurance. Get the umbrella insurance to keep yourself safe, for a couple of mil or something. But keep it in your personal name for the beginning. Open separate bank account. Treat it as a business for sure, because otherwise you can get disqualified. And I've seen it happen where it's not a business anymore. It becomes a hobby if you're not treating. So first things first, tax ID and a bank account. Entity-wise, buy those first 2 free properties, or flip those first 2, or collect 2, 3, 5 rentals. Then come to, professional and say, okay, what's my best way to do it? Because if you start overthinking what the tax implications are, if a deal is a deal, I always say, are you going to lose a deal that's going to make you $50,000 over $2,000 tax savings because you structured it incorrectly? No. So it just make it simple. Your job as an investor, really, ours as an investor, make sure your field is going correct. The paperwork, leave it to the pros, and it can always, a lot of things can be done retroactively. Of course, the earlier you come to an accountant, to a CPA, to attorney, the better. But don't start doing, a trust within an LLC. An LLC is, owned by a C Corp. It's crazy when you're first starting. It's a lot of information and a lot of unnecessary information out there.
Yeah, get the deal, lock it down, and then figure out the rest, all the minor details. I talk to people every day with this that want to get into real estate, want to get into short-term rentals specifically. where they have analysis paralysis, where it's like, there's so many things to do. Like, where do I run the numbers? Like, what entity do I create? Like, should it be in Delaware? Should it be in North Carolina? All these different questions, but it's like, put one foot in front of the other, know the numbers, get the deal as quickly as possible, and then figure out the rest. I'm pretty sure there's a window every year where you can essentially like change these things,
Absolutely.
right?
You can change into entity anytime. You can title and deed your property at any time. There's a million ways to do it. Make sure your liability insurance is good. Like I said, if you're really overly paranoid for liability purposes, get umbrella, but don't overthink your entity structure, because that first year or two, you're probably not going to make a ton of money, and you're just going to drive yourself crazy trying to save $50 somewhere,
Yeah, keep it super simple. Keep it super simple. Get the deal, close the deal, figure the rest out later. That's really, really important. I would say that's the most popular question that I personally get. I've had it as well from an investor standpoint. So I totally understand it. Thank you for shedding light there. So, I mean, really, it's kind of probably a pretty yes or no answer. So quarterly taxes, that's something from an employee standpoint. When I essentially went from a corporate job to a business owner, that's something that I never had to worry about. From the tax perspective, like, what kind of advice would you give somebody just starting out, where maybe they start an LLC, maybe they do it under their personal name, maybe they do the sole proprietorship route? What's kind of your recommendation with the quarterly taxes if they were to do the LLC route?
So to put it simply, again, LLC almost doesn't change anything for quarterly taxes. You're almost like self-employed, because all your income through LLC is flowing straight to your personal tax return. Because of that, all self-employed, you got to pay estimated taxes. Now, when I say you got to pay estimated taxes, the rule is if you expect your tax liability to be $1,000 or more per quarter, and that's tax liability, not your income. So you expecting that you're going to make, about $5,000 maybe a quarter, and $1,000, that's when you pay estimated. Now, it's all fancy IRS language. In real world, how many of us pay estimated? None. I don't even, because you do not know what your year is going to end. Why am I going to give IRS a few $1,000s? Because those penalties are not that bad, really. If you're not filing estimated. For non-filing taxes altogether, those penalties are quite big. But for not sending them a quarterly check, it's really not that significant. A lot of my clients choose to just not send anything until the taxes, actually due March 15th or April 15th. That depends on what kind of entity you have. And, the partnerships and S Corps file in March, and the rest of us in April, just like individuals. But if you have that extra cash and you don't want to face that big, I've had years myself where like, whoa, $15,000 in taxes in April is not fun. If you want to offset that a little bit, I would send, a quarterly check but estimating it becomes really difficult, especially in real estate. We know how real estate is. 1 month you are doing 3 flips, and another 2 months you do nothing. And it's not taxed until it's actually sold. So it's very difficult to predict the bottom line. There are, larger companies where we know their volume. I sit in those quarterly and annual meetings all day long, and we are able to predict somewhat of our bottom line. Otherwise, it's very difficult to say, as a showing of goodwill, if you feel like you want to send 1,000 or 2,000 quarterly, if you think you're going to make, 20 this year, so send 4, which is about 20% bracket. You'll be safe then for sure.
General rule of thumb, I just want to make sure I understand as well. So like each quarter, you're supposed to, what was the 1,000 to 5,000? Explain that again.
So it all, again, our brackets can fluctuate. I might be in a 10% bracket, and you might be in a 37% bracket, depending on what you made that year. That sort of becomes very difficult. But the sort of general rule of thumb as accountants have 20 to 25% of what you think your bottom line is. Divide that up 4 pieces and send that piece, if that makes you feel good. Now, once you decide to go with an S Corp and start paying yourself salary, it becomes even easier. You're withholding your taxes and you're sending quarterly forms anyways as a company. And it gets a little more complicated. The forms, do not ever try to process payroll yourself, please, because it can create the biggest chaos, and it's the biggest liability. It's the most audited item on IRS list is payroll taxes. So don't mess with those. Hire a third party. $35 a month, totally not worth doing it.
That's something that we talk about a lot with our investors and potential investors is you could definitely do it yourself. Like you could file your own taxes. You could run your own short-term rental and Airbnb, but it's like, what is the opportunity cost of doing it wrong, or even the time and effort that you're learning it, maybe the right way, maybe the incorrect way. So we always say, hire a professional, especially with taxes, property management, like hire somebody, because you will make mistakes. Nobody's perfect, but it's more about getting it right the first time. Yes, you might pay a little bit on the front end. The amount that you will avoid the mistakes on the long term is absolutely going to be worth it.
I could give you a long list of clients that came to me with where we feel like, why didn't you come 4 years ago? Because at this point, a lot of times it's you can't go back and fix it anymore, or you just don't want to fix, because the adjusted tax returns is the biggest red flag. You will get audited if you send adjusted tax returns. So if a mistake is large enough, a few $1,000s, it might be worth sending it. But most of the time when I get the clients, and it breaks my heart when I see how much we missed out because their books were not in order, and the CPA, people have a misconception about that. If I give the numbers to CPA, he's going to do everything he's going to do with it. CPAs don't have that time. That's not what they do. We take the numbers that you give them. We don't dig behind the number. How did you arrive at that number? That was your job, kind of. We just simply don't have a capacity to go drill into your number. This is where we usually come in. We put your numbers so that CPA doesn't have to drill anywhere. Going back into the experiences, because nobody drilled, there's tens of thousands of dollars for one of my clients. It was almost $60,000 in law that we could have taken in deductions.
Wow.
And he paid me $4,000 to find it. So,
wow.
Like you said, there's, we got to outweigh the risk with the benefit. I'm not, not trying to drum my own rule, but I don't repair IT. I hire, I do what I know how to do. Do I know how to lay tile? Absolutely. Would I do it? No, because it's probably going to fall off in 2 years.
Yeah. It's an expensive mistake. And the problem with that is you don't really know until you make it, until it's too late. So we have people that will come back to us and be like, I tried listing on Airbnb and, I had a terrible guest, like they wrecked my place. I'm like, okay, did you do the X, Y, and Z? They're like, no, like, why would I do that? I'm like, okay, that will shield you from having your place wrecked or whatever. Yes. So we see it on the short-term rental management side as well. So thank you for sharing that.
It works exactly the same for the short or long-term rentals. If you're a person that really enjoys laying tile and evicting, your tenants, go nuts with it. But 10%, 20% to pay to a management company, to me, I have a job. I'm not looking for a second one, Right. And a lot of us as real estate investors, we try to become IT people and marketing people and accountants, and we mess it up.
Yeah. And I'm not saying be completely oblivious to it. Like, I think everybody should at least understand, what an S Corp is, what a corporation is, what a sole proprietorship, to have these like next level kind of conversations, but you don't need to know all the intricacies of what an S Corp is and like what the pass-through entity means and yada, yada, yada. So it's like, get a base level of info, take it to a professional, let them kind of advise you on your situation and what they recommend, and eventually make a decision from there. That's how to keep it super, super simple.
And your situation is going to change from year to year. You started with one or two properties. Now you may be at 5 or 6 or 7, and now you want to manage for other people. Let's see, that completely changes. Your active passive structure changes. Your entities change, which entities and what type of entities you put which properties in. Your accounting changes completely when you start managing for other people. It's like day and night. The managing for yourself and managing for other people, liability goes through the roof if your accounting is not done correctly, because you're dealing with somebody else's money. It's not your money, really.
Yeah, and with the trust accounting and the laws in North Carolina with just doing the trust accounting correctly is very, very important. So I'm glad you mentioned it. Active versus passive. This is probably the second most popular question that I get. Am I active investor or a passive investor? From the tax perspective, like, what are you seeing? How are you kind of differentiating that with your client?
And I'm going to sound like attorneys and accountants again. It depends. But it truly does depend. I know as investors for many, many years, we were like this passive. We like programmed to look for passive income and passive losses and to offset our depreciation, because for the longest time, as investors just had long-term rentals. And our biggest deduction was depreciation. But you couldn't offset depreciation expense against your W-2 income because one was passive and one was active. And it just got to sit there until you actually start making money. So we sort of all got programs that we need passive. Airbnb's brought a totally new era in this tax perspective. We don't know what's better for you. Is passive better or active better? Number one, to just define passive tax brackets are very simple: 0, 10, and 15. That's it. And that's some sort of passive activity, like, lending money is passive, buying stocks, believe it or not, is not. But, your regular rental is on regular basis. If you just mom and pop shop renting 4 properties, you are going to be considered having passive income. When depreciation comes in and repairs and everything, a lot of times us with few rentals end up with a loss. That's where we, for the longest time as real estate investors, like, I gotta have passive income. Because the only way you can take advantage of that loss, you can't just deduct it on your tax returns against your regular job or other businesses that you're running. It's gotta be passive offsetting passive and active offsetting active income. So now the Airbnb, initially when it started, and it's so much confusion about it, and it still is, like, for the last couple of months, I talked to at least 10 accountants at CPAs. I went to a seminar in Atlanta. John Heyer was actually talking about it for a little bit. Everybody has different perspectives. IRS has not defined it properly, until almost like at the very end of last year. It pretty much started bleeding. So the general consensus out of like 17 CPAs that I talked to is, if it's 7 days or less on average per year, now you have active income. If your stay is 7 days or less, active income is not a devilish word anymore. Because majority of us, what are we doing when we have Airbnbs? We either have a W-2 job, a 1099 business, or something. Why not offset that in the first year of losses? So, it depends what your situation is and what you're looking to get out of it. For some people, we want purely passive then income. You probably should give it to a management company then, or open a management company and let your management company manage your properties. So it literally depends on the situation. And I don't want to, I know it's a lot of influence, kind of gets confusing, but it depends what most beneficial to you would be. Whatever properties do you have, what businesses, activities do you do?
That's a good point. One thing I wanted to dive in on, you said active offsets active, passive offsets passive. I think there's a lot of confusion around having passive income offset the active income, like your W-2 or your salary job, which is not the case, correct? You can't do that.
Unless the only exception is, without diving too deep, you all probably heard about the real estate professional status. That's when your rental income becomes active if you can qualify as a real estate professional. Very, very complicated topic. We could talk for hours, but 90% of us don't qualify unless you're an actual realtor. If you have another job, you just don't qualify because it's not enough hours in a day for you to qualify for what IRS asks for 750 hours a year, plus a million other little things, what qualifies you. But 99% of the time, your rental is going to be, passive.
So 750 is the real estate professional level hours per year.
Yes, and that's just one of the qualifying factors. Then you got to be actively involved in it. It gets really complicated. Then you got to track those. If you have another job, you pretty much are not going to qualify, to summarize it.
That's a very complicated question. Everybody's scenario is going to be different. Like for us, like for the business owners, we manage our own properties. So that's another kind of curveball here. No need to really go into that. Everybody's scenario is going to be completely different with active versus passive. To summarize, active can only offset active income. And chances are, if you're a real estate investor, you're probably a passive income or a passive investor, correct?
If you are holding rentals primarily, you are probably passive. If you're doing flips and new builds and stuff, then you can qualify for it. But there's a whole bunch of course, IRS doesn't make it easy. There's a reason they have 170,000 pages in IRS tax code, so it's a million things. Like even for the flippers, some of my flippers don't qualify as active because we don't spend enough time in that part of the business because their rental portfolio is bigger than their flip or new build portfolio at the given time. And you got to requalify every year. Actually, it changes at the end of your tax year. Your CPA will run all these tests, material participation tests, the hours. It gets really tricky. Definitely a CPA question. Don't try, to send to CPA a number and say, no, I actively managed. As a matter of fact, if your handyman spends 2 hours more than you on that property, you're already not active. You got to spend more time than anybody else on that property to qualify as active. So it's a lot of little, qualifications for active.
How would the IRS prove that? Like, would they ask for, time records? Like, how would that conversation go?
Emails, time records. What IRS always asks is what they call contemporaneous time records. Not that you just sat down in December and said, okay, I spent 3 hours here, 7 there. It's got to be pretty detailed descriptions and actively, your texts and your emails with your handyman, with your, with your cleaning ladies, with your, whatever people you're dealing with. If you want to show that, let's say me as an accountant, I can prove all day long that I have over 200 emails going out a day. As a real estate investor, it gets a little bit tricky. So you really got to keep a good time log, mileage log, all the conversations, all the emails. It becomes quite a lot of times it's not worth it, to be honest. Every CPA I ever spoke to, all the accountants know how difficult it is to qualify unless you're a real estate agent or active true flipper, 100% constantly in construction zone, managing those projects yourself, not just sitting in the office and managing other people. If your supervisor, for the site spend more time there, you don't qualify already.
Yeah, I just did 750 hours divided by 52 weeks. That's 14.4 hours per week that you would need to at least be an active participant in that business. So it's a lot. It's a lot.
It's a lot. And there's, like I said, there's level tests. Once you pass that hour test, there are other tests, the material participation test, the investment test. It's kind of complicated. I just sat in a 2-hour seminar and I still could not wrap my mind completely on all different situations. You got to sit down with a person and talk. And, most of your CPAs are going to know if you're going to qualify or not. It's going to take you a 10-minute call with a CPA and say, okay, this is what I'm working on now. That's what I'm going to be working this year. Do you think I can qualify? What can I do better and keep a better record or change a little bit of ways that I'm doing business to qualify or not qualify?
Long story short, chances are you probably will not qualify as an active investor unless you're, a realtor or heavily involved in flipping.
And that is for long-term rentals. However, Airbnb automatically makes you an active. That's why IRS starts fighting each other at the one page over another. For the longest time, we couldn't determine what is Airbnb. Is it a hotel? Is it a long-term rental? Just your standard rental. So finally, about at the end of last year, the definitions were very, very unclear. CPAs were pulling their hairs out, didn't know how to treat it. But majority now came to the conclusion that pretty much most of the Airbnbs are going to be your active income because of that 7-day rule, and also because participation rule, where unless you actually hire a management company, it's going to be active.
Yeah.
Anybody that makes, I actually just read up right before this, I was reading up for one of my clients, and I'm like, let me find actually that actual page in IRS law. And it literally says, if you are making decisions for that Airbnb, it's active, which is you admitting guests or not admitting, where are you listing it, who are you, it's going to be active unless all that is taken by the management company and you just literally get your check at the end of the month.
Yeah. So my Tripify, we would be actively managing it and the investor would be passively managing in that aspect. Yeah.
Correct.
Yeah.
Yep.
If somebody, and just to clarify, if somebody is self-managing their own Airbnb, that would be active.
That would be active. Another piece on Airbnb that is just a little bit different also from the long-term rentals. We are used to a long-term rental depreciation over 27 and a half years. IRS decided because Airbnb is active business per se, it becomes a business real estate, and it's depreciated over 39 years instead of 27.
Interesting. Okay, so not the 27 years, it's 39 years.
Like commercial property always was 39, and because of that active rule, IRS kind of qualifies it as an active business asset, and now it drags out your depreciation a little longer.
That's something I was not aware of. Yeah. Cool. Anything else on active versus passive before we move on?
I guess just to simplify and pinpoint, you have a W-2 income, don't be afraid of that active income. If you're just managing one or two Airbnbs, don't be afraid. If you lost money because you changed all the decorations and you bought new sheets and everything, now it's going to offset your W-2 income. That one is pretty difficult to offset. So it's not always necessarily shooting for passive. Just look at your situation, what makes more sense for you.
Really good info. So, the next question, a couple more before we wrap up. I really appreciate your time. The next question for you, what are the biggest deductions that you see? What are some advantages that some real estate investors could take advantage of from the tax law, legally, of course?
So that's where having a company definitely helps. Now, going back to that LLC, it's just easier to deduct everything from your printer paper to, it's deductible either way, but it legitimizes when you have a tax ID and it's not your personal name on the listing, it's company name on the listing, it's company name on all the documents. The tax ID, you don't spreading your social security left and right to everybody yet, because we're going to give you 1099s here. I don't know if everybody's aware, but Airbnb and VRBO gives you 1099s only if you've done, I think Airbnb is 200 stays and $20,000. That's the only time we start issuing. We don't do, I guess, for the smaller hosts, but everything is deductible. It's a matter of timing. So I get asked that a lot. Okay, my repairs, I redid so you bought this beat up little house and you turned it into cute, 2-bedroom, 1-bath Airbnb. What's deductible, what's not? Everything is, it just matters when. Your repairs, your roof, your walls, your flooring, your cabinets, those are going to go straight on your balance sheet as an asset and get depreciated over that 39 or 27 years, depending long or short term. Now you start getting into furniture. One of the biggest mistakes I see people make is we just lump it all because you don't have tenants. So nothing is deductible until it's actually ready to rent and advertised. So when you first buy that little house, you're like, okay, I did all the renovations. Now I got to fill it with furniture and pictures and towels and soaps and everything else. And because it's not operating yet, I see the bookkeepers constantly lumping it together, your property costs, your repair costs. Your furniture is depreciated over 5 years. And as a matter of fact, we can take an expense, the whole 100% for furniture, if we use that section 179 that everybody loves talking about, or bonus depreciation. You can actually get to deduct your furniture in the first year if you do it right. But majority of the times I see it booked incorrectly. We just lumping everything into that one account. Then we start renting. Then of course the soaps and the shampoos and the and the waters, that stuff of course is deductible as a part of running business. But a lot of investors lose out on those initial costs on their sheets, on their towels, on their flowers and pictures and books and TVs and stuff like that. Imagine if you're depreciating a $12 set of sheet over 39 years, how much deduction are you getting? So it all can be deducted, but it needs to be accounted properly. So that's the biggest probably mistake that I see, not taking advantage.
That sounds really complicated. Like, how would you advise somebody to do that on a simplified level?
So if you are doing it yourself, let's say it's your only Airbnb and you're doing it yourself, keep a really good spreadsheet to where separate your major repairs, your furniture, your supplies into different categories. Now that at the end of the year, when you come to your CPA, even if nobody's doing your books, you're doing it yourself, get yourself an Excel sheet, a Google sheet, keep the major repairs on, don't give a CPA, 172 lines to untangle because we're not going to do it. But for simplicity purposes, anything attached to the house is going to be long-term. It's going to be depreciated. Your cabinets, your flooring, your roof, your windows, those, there's no way around it. It's improvement of the property, and that's going to have to get depreciated over 39 years. Anything that you can pick up and remove, your beds, your furniture, your washers, dryers, microwaves, stuff like that can be actually deducted the first year, and as either that section 179 or bonus depreciation. You don't even need to know those terms, but separate it for your CPA. And then you definitely separate your supplies. That gets deducted immediately. Your shampoos, your soaps, your cleaning supplies, towels, paper towels, anything that you provide your guests with, your chocolates, of course, everything is deductible that year. But just as when you go to CPA, he's not going to have a capability to go see, was that Amazon charge, for soap, or was it for the curtain rod that is attached to the house? So you kind of keep in mind that way.
Yeah. So mainly, like, it sounds to me, correct me if I'm wrong, like mainly renovations, like the things that are attached to the house are going to be depreciated over 39 years. And then the other things like towels, linen, soaps, like kitchenware, things like that will be deducted immediately in that first year.
Sometimes depreciation is not a bad word sometimes, because what if you made a really big loss that year? So maybe you want to, postpone deducting even more things. So your bottom line is not, so now depreciate that furniture and that living room set and that refrigerator for 5 years, because legitimately that's what it is. But that very first year, IRS gives you a break and says, hey, you can deduct it all in 1 year once you placed it in service, the furnitures and the refrigerators and computers and stuff like that you put in the house. It gets a little, of course, more complicated than that, but for simplicity purposes, all the reusables that you go to Walmart for all the time, that's 100% deductible. Put it in a totally separate spreadsheet. Your big items, your furniture, your appliances, those, depending on your situation, CPA will advise you what to do with it. But don't go deducting it right off your bottom line, because per IRS rules, there is a special format you got to file if you deducting those. You can't just take it off your off your profit.
From a just a super simplified level, like if somebody's going to come to you with their documents, like what are the main things that you're looking for? Like the top, let's say 5 to 10 categories. I know it's really about the categories from an accounting perspective. Like kind of run through those for somebody that has never been in this game or is pretty new to the real estate game.
So that, when people come to me, I usually, of course, I go through each and every transaction, reconcile the bank, make sure that and allocate in those categories. But as long as you're looking at your business being, and you once a month sit down and say, okay, is this a day-to-day for me necessary to run business expense, which is just open your pens and your papers, or is this going to last me a few years? And that's exactly how IRS is going to look at it. Your bed, you're not buying a new bed or a new mattress every year or every week or after every, guest. Those are going to probably go into a separate bucket that you need to show your CPA and let them decide what's the best way to write it off. All your daily stuff, your towels don't last longer than a year. Well, we look at it almost like, again, that long-term, short-term, just like real estate. If it doesn't last a year, it's going straight off your bottom line. You get to expense it exactly that same year. If it's something that is going to last longer, now where the separation comes in a little bit. Your repairs are going to be a part of a house, everything attached to the house. Your furniture is going to be a separate category.
Yeah.
So for simplicity purposes, the house, the furniture, and the dailies, that are going to get expensed in a year.
Yeah. So those, that's the way I'm kind of thinking through it from on a personal level. It's like the house, rehab, repairs, renovations, and then the furniture. And then we call it supplies at my Triple Five, where it's like soap, towels, linen, things like that, to really just make the property rentable from day one. So really kind of those 3 categories. So somebody that's just kind of starting out, those are the 3 categories that, Diana or your accountant will essentially look for whenever you're thinking about doing deductions, of course.
Absolutely. And then now it gets just a bit more complicated. Once it's rented, let's say that table broke. Now you need to replace it. After it's rented, the rules become a little bit looser. After you started putting the tenants in, you can deduct what they call, and again, your CPA would have to help you with, there is a so-called de minimis safe harbor rule, where any item over under $2,500, you can expense it in that year if the property is already rented. So a table broke, a chair broke down, you need to replace it. You replace it and you deduct it. You don't put it anywhere, you don't depreciate it. So it gets a little more, but again, there is a form, don't do it yourself. Don't start filling out the minimus forms for IRS because we will deny you, But once property rented, it becomes much easier to deduct a lot of things, because once the property is rented, the way IRS looks at it, it has to be maintained in order to run as a business. So if your AC broke, you're not going to capitalize, $1,000 repair for AC. If you're changing the whole system for $10,000, yes, it will have to get depreciated over time. But if you just repaired it, they replaced a piece of pipe or this faucet or the shower, that gets expensed exactly that same year.
Yeah. So, let's rewind a couple months. It's year end. Let's say we made 30 grand net. Would it be smart to look around, look at the property and be like, okay, yep, this furniture has some wear and tear. Should we replace this? Like that right there.
Absolutely.
Okay. Yeah. I just want to make sure that I don't know where they kind of draw the line.
Absolutely. Majority of my clients, I try to put those meetings in about September, October, so you can make those decisions. Don't come to me on, December 29th, say, hey, should I or should I not? Because I don't know what your bottom line is going to be, But if you're keeping decent books, you know approximately what your bottom line. If you're running into negative, don't start spending more money just to get a tax advantage. But if you like you said, if you're going to make 30, why don't I buy a couple couches for, but we got to be under 2,500 each, And that's again separating.
Is it 2,500 total or 25 a piece?
2,500 per item. That's where there is a lot of things that we can play with. Also, buy 2 chairs and then another 2 and then another 2 instead of a whole, So as long as you receive this separated, they're separate items. So that's per item, and that de minimis rule can do a lot of damage to your bottom line in the good,
Yeah, for sure. Yeah, no, that's genius. Yeah, I mean, as you know, we're a licensed firm. We have to do trust accounting on a monthly reconciliation monthly. So like all of our investors get a monthly report of like, okay, this is income, this is the expenses, here's your disbursement. So if you are using a management company and like we do all the work. We make it super simple for you guys to essentially just collect it. You'll have a report. We use QuickBooks, which is actually a future question that I had. But yeah, so we make it super, super simple for you. If you're doing your own, make sure you're crossing your T's, dotting your I's with doing your own books. But yeah, no, that's really, really helpful. Hopefully everybody got some value there. I think you may have alluded to it. Really 2 more questions for you, and I'll let you run. I really appreciate your time tonight. What's the biggest mistake you've seen in the accounting space with real estate?
Oh, that one actually got me intrigued when you asked me. I made a list. I'm like, wait a minute, let me think now. Through all these years, 20 years accounting and 20 years in investing. There's the whole list. So, but not to make it, overly complicated. We don't want to be here for 3 hours. We're not recording correctly, like we talked about, your expenses, your house, your repairs, your furniture, your supplies. Putting it in the wrong category, CPA is not going to untangle it on March 15th. You're going to lose on deduction. Or you're going to do something that might cause future audit issues, if you deduct too much, because I see that a lot also go in the opposite way. Mom is doing my accounting and, at her home office, and mom doesn't know tax rules. So she just deducts everything. You can get in trouble quite a bit with that if it's in the wrong category. So not booking it correctly. In that same not booking, not recording it correctly category is the Airbnb and VRBO, our income, our short-term income. What I see happening a lot, everybody knows when you put it on Airbnb, okay, so that you don't get what the guest actually paid. You have your listing fees, you have your taxes, So, but majority of people, I see them, okay, I rented for 600, but I received 530. That's my income. That's not your income, because what's going to happen, then we touched on those 1099s. When you're small, you might not run into that issue, but for the bigger guys that have multiple properties, you're going to get a 1099 from Airbnb that is going to be way larger than what you said, because you just said, I deposited only $530, but Airbnb says, you made 600, and you're not showing it.
Yeah, your gross income will be 600 with $70 in
exactly
whatever
less the
tax.
Fee. Yep. And one of the big mistakes I see people not booking their cleaning income as income. It is income to you until you paid out that cleaning lady. That's your income. It doesn't mean you're going to pay exactly the same amount to the cleaning lady, but it's part of your gross income, that cleaning fee.
Yeah, I mean, the cleaning is passed on to the guest in most scenarios, but it's income. But also an expense.
It's also an expense once you pay your cleaning crew.
Yeah.
Kind of touching back on that in-service rule for your deductions, until it's in service, until it's actually ready and advertised, and you can't deduct a thing, kind of, because it's not even a working asset. So IRS looks at that date put in service as a date when you can start writing off like crazy. Everything becomes writable off now. The long-term rentals, a lot of times it's great situation if you inherit a tenant when you buy. So what happens if you bought a property and there was a tenant there, and a week later you say, okay, we're not friends anymore, I'm gonna turn it into Airbnb. That asset was in service already when you got it. Now you get to deduct way more stuff up front because it was rented before. So if you buy it empty, if you buy it vacant and you're doing all these renovations, up to the day that you opened up to a first guest, a lot of things are not deductible. But if somebody was living there, remember when I mentioned that, hey, you got to make it livable, then the tenant was there already and you're just repairing a little bit, although a lot of those repairs can get deducted. So that in-service date is super, super important. And then I run financials from I look over and over and over again. When was that first day that we got the money? And that's a day that you're going to start deducting all these other things that otherwise would not be deductible.
If it gets listed on January 1 and the first reservation doesn't start till, let's say, February 1, is January 1 the date, or is it when actual?
If it's listed, January 1 is the date. Yep. If you can prove to IRS, and all of these things are only if you. Everything is only in a case of audit. If audit comes, can you prove to IRS that it was online on January 1st? That's a biggie, because otherwise, until you're renovating, there are two things that you can deduct. It's interest and taxes while you're renovating. Doesn't matter. So let's say you bought a property in 2021 at the end of it, and you're not going to rent it till 22. The only two things you're going to be able to deduct is interest and taxes, real estate taxes. The rest of the stuff, everything will have to get capitalized. But if there was a tenant in place, and then you lost the tenant and then you started renovating, now you can deduct utilities, insurance, and all this other fancy stuff if it was already rented. So your deductions become much, much larger if there was tenant in place. So that one is a big one. Not separate, I put down not separating per property, but it depends. For the guys that have multiple properties, there's a lot of value in separating your income and your expenses per property. It makes your CPA's life much easier because every property has its history. What kind of repairs? When did we rent? It has different dates. If you're using QuickBooks, you know exactly what I'm talking about. Classes, usually, that's what we call, you separate per property so you can run a P&L for one property and see how that P&L did. So not only does it help owner to make executive decisions, is the property really making sense as a long-term or short-term? Or am I really making money, or is it a little bit too much of a headache? But it also allows for CPA to look at it real quick at the glance and say, okay, what are we doing with this one? What are we, allows for good tax and financial planning if you're separating your property, and of course there's always going to be overhead expenses. So, your office expenses, your gas, your meals and entertainment, your travel, stuff like that. But separating per property is a biggie to me, because you can tell a lot of things by it. You, as a management property, when you send it to the owners, you probably want to know how each property is doing. Then the last one, it seems like not a huge deal, but because we just been through the 1099 mayhem, I remind every time to my clients, you're cutting a check, you get the W-9 from that person. You're writing a check, get the W-9 form. W-9 is their information form, pretty much. Your name, the address, and the tax ID. I have a social or the whatever entity ID we have. You don't have that, then you cut the check. January 31st comes, you need to issue those 1099s. Nobody's going to give it to you. Believe me, in my 20 years, there's nothing worse than making those calls on January 29th. You cleaned for me at the beginning of January. Now it's December. I would like to know your social security so I can report your income to IRS. Like, who's going to give you a number?
And the threshold is $600, right? Anything under, you don't have to worry about it. Anything over $600,
anything over $600, correct. And then with this new law just passed in December, the world is going to change a little bit, because not sure how IRS is planning to implement it, but we said, okay, PayPal's and Zells and Cash Apps, you're all going to have to issue 1099s. It is causing absolute nightmare in those industries. Seeing people running like chickens with no heads working for those companies. Who knows? Am I paying my friend back for a loan, or am I paying my friend for cleaning my property? How are we going to separate it?
Yeah, and I know Venmo specifically is doing like the business profile, and I'm sure PayPal is something similar. But I mean, what are your thoughts on that? I'm glad you brought that up. Like, what are you telling your clients for the
This is going to be nearly a manageable task for those companies, but for our clients, I said I'm blessed. We don't have to do it anymore. If government tells Zelle and Cash App to do it, that means we don't have to do it. As long as we're doing it correctly on our end, setting up as a business with our tax ID, anything that comes out of our account, Now it's Zell's problem to actually get tax ID from a person that you send.
Like, let's say I split rent with a roommate and I Venmo them $601. They're not a contractor. I'm not paying them to do work. Like, I feel like this is going to be an absolute nightmare.
This is going to be an absolute nightmare.
From the, not really your perspective or Zell's perspective, but from like a consumer perspective and investor perspective. Because if you're using Venmo, you're going to spend more than $600 a year. So
absolutely.
You're going to have so many 1099s.
So as it stands now, almost nobody knows how to handle it, including host companies and us as small people. How many times have we, rented an Airbnb with friends and we split the cost, and it's women more than $600 if you stayed a week. Now you're telling me you're going to send my friend the 1099 for money that it does. So this is going to be a learning process, I think, for all of us. My main suggestion that from all the discussions with professionals said, make sure at least you keep in your business and your personal accounts, separated, with separate bank accounts and a separate email, one on personal, one on business. So at least if somebody turns around and comes looking for it, these are my personal things. I should have never gotten 1099 for it. These are my business things. And I didn't send my vendors 1099s. So at least to have those two things clearly separated.
Yeah. Okay. So essentially creating two accounts.
Me, myself, I have two accounts on everything, on PayPal, on Zelle. It connected my business to my business email and my business bank account, and my personal to my personal email and to my personal bank account. This way, at least then these two buckets are separate. Nobody knows how it's going to operate. And in all reality, just fun fact, I don't know how IRS is planning on doing it because IRS is still auditing 2019 tax returns right now. So I don't know how we're going to enforce it. I don't know how we're going to come and check on Zell's or on our small vendors. It's beyond, it's beyond.
We'll find out in 2024, right?
I think so, or later.
So, really, just kind of wrapping up. This is a personal question with, like, we use QuickBooks for everything. This is what we do, the reconciliations and all of our client accounting and business accounting. For somebody just starting out, like, what QuickBooks packages? So it seems like there's 10 different packages. Like, what would you recommend? What has the most bang for your buck? Like QuickBooks Online, QuickBooks Essentials. Like, where would you kind of start out for a real estate investor that's just starting out, where he can have not all the bells and whistles, but also not the base level product? You know what I mean?
If we would be live, you might want to smack me, but I see it depends again, because it depends. Of course, online and desktop, these are first two differences. Online, it depends what your operation is looking like. Do you need your accountant to log in whenever? Do you need, a bookkeeper or somebody entering data to log in and see it? For myself, can I log in as an accountant and my client's wife and a client himself wants to log in? Phenomenal solution online. However, it's pricey. For small starting beginners, you can start and let's say you have just one property, two properties, up to about 4 properties. You're going to do just fine with the QuickBooks Essentials online, which is like $25 for first year. But after about 4 properties, I have love-hate relationship with QuickBooks. But they know we are monopoly and they know what people need. So they don't give those functions that easily. After you acquired about 4 or 5 properties, you need that, what they call class function, which allows you to run P&Ls and, your financials per property and to see how you're doing per property and on each project or flipping project or your Airbnb or whatever. And at that point, they charge you $80 a month, online. So it can be quite pricey for somebody that just runs 2, 3, 4 properties. $1,000 a year, it gets pricey. But that is the best. I think it's called Plus, that $80 version. Yeah, so for a small one, you can go further forever. There's, all these pros and everything else at $180, a month. We're never going to grow, most of us small businesses, to that level where we're going to, run out of 1,000 properties, so it's just not going to happen. Now, solution to that is because of the priciness. I'm starting to move, actually, majority in the last year, I moved probably 50% of my clients to QuickBooks Desktop, but with a remote server. And let's see, we work with this little company called CloudWorks, I think, or something like that. Literally, I buy my QuickBooks, I put all those QuickBooks files in there, and my clients just log in and just pay for their access $35 a month to log in into their books. And whoever wants to log, it's almost like online, but you're actually using desktop product, which as a matter of fact is a much better product. It's much more functional. It's much faster. QuickBooks Desktop is much better. So if you're just starting out, buy an old QuickBooks, 2017 QuickBooks, 2016. You can find them on eBay for $45 and keep it on a desktop. Don't go online until you know what you're doing, until you're getting bigger. Do it on your desktop. If nobody but you and your wife needs to access that data, what's the point of paying that, even $25 online? Whenever you grow big and you start seeing that, hey, I'm traveling a lot, I would love to look at my number, at my numbers on the fly on my phone, then maybe travel to online version or something. But for beginners, I always recommend everybody buy an old version of QuickBooks. If you're not doing payroll and you're not running credit cards through it, it's never old. It just doesn't expire ever. You can use it forever. I have clients that still on their desktop still have 2008s and 2011s and perfectly functional software.
I used to work in IT. My thought is like, okay, what if that computer crashes?
Great point. Your desktop, your most desktop like versions, because there's also versions there also, but we need just the lowest version. Gives us everything. No need for pros, no need for all those big suites and everything for small investors, but backup. I back up everything. Like my remote server guys back it up. I back it up on my desktop, and I back it up on the cloud, and I back it up on my terabyte. Like, because you lose that data. And ask me how I know.
It's probably happened.
It happened to me with a client with 10 years of data, and how where are you gonna get it?
Yeah.
So definitely back it up. Even if you just buy, a nice little flash drive and just set up automatically. It has a function to set it up. Every time you log out, it backs it up wherever you tell it to, or at a certain time on a certain date to constantly back up. But definitely make backups for the desktop version.
Yeah.
And
agreed there.
Even with online, like I wouldn't see backups, but a lot of people are using online has all these functions now, bells and whistles like our iPhones. Hey, put an attachment. So people end up saving like their statements and their receipts and everything in online. Guess where it goes if you decide to convert to the desktop? Nowhere.
Really?
Yep. So, and QuickBooks is working on it. And I don't know if we came up with a solution, but I know as of last year, we didn't have a solution. I converted a few clients and I ended up losing all these documents with attached. So it just, I usually, that's what I'm in accounting. I'm paranoid about its numbers. It's sensitive stuff. You start talking about money, you better have your stuff secure.
Yeah, no, that's valuable info right there. I appreciate that. Yeah. All right. Well, cool. Diane, once again, what's the website or email where people can reach out to you?
Diana, DIANA @sbfconsultants.com. Small Business Financial. I know I could have picked a better domain, but and the website is sbfconsultants.com. We in Charlotte or Pineville, North Carolina, but majority of my clients online, and majority of my number, it's my cell phone and it's an office number because we are small, sort of intimate company. We know our clients in and out. We know where life's, so it's my cell phone number that you can reach me at 980-365-1008.
365-1008. All right, perfect. I will put it in the comments of this so people can reach out to you. Diana, I really appreciate it. This was super helpful to me personally.
Might have been too much and too long. I'm sorry.
That is completely fine. I can tell you're passionate about what you do. I could talk about Airbnb and short-term rentals for hours as well. So I get it. Yeah, once again, reach out to Diana if you have any accounting questions. I really appreciate your time.
Thank you. Thanks for having me.